Hi guys. Today we will analyze Barrick Gold stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative. The long-term trend is negative. There should be more interesting stocks out there. Strong support level is around $21. Next strong support levels are around $19.80 and $17.60. Strong resistance level is around $23.40. Next strong resistance level is around $25. In the last month the stock has been trading between $19.70 and $23.40 range. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 19.2 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 9% per year, for last 5 years. We see that the average profit margin of the stock has been around 14% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 58% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Barrick Gold Company: bad, average, and good. First scenario. Barrick Gold will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, -2%. Future profit margin would be a low, 13%. Future free cash flow to net income rate would be a low, 50%. In this case, the fair value of the stock today would be $19. Second scenario. Barrick Gold will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 0%. Future profit margin would be average, 14%. Future free cash flow to net income rate would be average, 60%. In this case, the fair value of the stock today would be $26. Third scenario. Barrick Gold will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 2%. Future profit margin would be high, 15%. Future free cash flow to net income rate would be high, 70%. In this case, the fair value of the stock today would be $36. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 1.08. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Barrick Gold, analysts forecast growth rate around 2% per year in next 5 years, and future P/E around 18. Again, I will use 3 different scenarios for Barrick Gold Company: bad, average, and good. First scenario. Barrick Gold will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, -2%. Future P/E would be a low, 16. In this case, the fair value of the stock today would be $6. Second scenario. Barrick Gold will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 0%. Future PE would be average, 18. In this case, the fair value of the stock today would be $8. Third scenario. Barrick Gold will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 2%. Future PE would be high, 20. In this case, the fair value of the stock today would be $11. As you can see, today the stock is overvalued, $21, even if we expect the company's high performance in future. The fundamentals are good, but there are signs of a wider economic slowdown. Based on estimates for the next 5 years, the company will show a very small, or even a negative growth in revenue. This is not good. Based on that, the stock looks overpriced at the moment. It's a highly cyclical stock. In times of rising interest rates, cyclical stocks perform poorly. I will definitely not buy it in 2022. Company's strengths. Barrick Gold Corporation is a mining company that produces gold and copper with 16 operating sites in 13 countries. It's one of the world's largest gold companies in terms of both production and reserves. It is headquartered in Toronto, Canada. The company's results are linked to trends in gold production and pricing. When stocks get volatile, and global economic conditions become unpredictable, investors often flock to gold. As long as global economic uncertainty and virus fears are part of the market conversation, gold is likely to remain in demand. Barrick's portfolio of mines helps diversify mine-specific and geopolitical risk that all gold miners face. High-quality pipeline of growth projects. The Nevada J.V. with Newmont Corporation should drive significant synergies and be a tailwind to earnings growth for several years. Barrick has a clean balance sheet. The company has no significant debt maturities until 2033. The company's return on assets of 4% and profit margin of 16% are amongst the best returns of the industry. Risks. The primary risk for investors is gold and copper price volatility. The risk of falling gold prices overshadows any operational improvements the company can execute. Other risks include operating cost inflation, failure to achieve expected gold and copper production forecasts, and challenges replacing reserves. The company also faces a variety of political, financial, operational, country, regulatory and foreign exchange risks. It's a highly cyclical industry, and gold prices have already peaked for this cycle. Investors looking for gold exposure can skirt company-specific risk by investing in gold-backed ETFs. The company has a return on equity of 8%. This is below the industry average of 12%. The company is expected to show a small growth in earnings per share. In the coming 5 years, the EPS will grow by 0 to 5% yearly. The revenue is expected to grow by only 0 to 2% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.